Picture this. Bitcoin hits all-time highs. Major institutions are buying. ETFs are approved. Everything points to the price exploding upward. But instead, it just sits there. Or worse, it drops. If you've been watching Bitcoin lately and thinking, this makes absolutely no sense, you're not alone. Today, I'm going to show you a financial mechanism that's been used for over a century to control asset prices, completely legally. No conspiracy theories, just financial engineering. By the end of this video, you'll understand exactly how large institutions can suppress prices, why they'd want to, and what it means for anyone holding Bitcoin. Let me start with a simple example. Imagine you're a country that needs money to build infrastructure, so you borrow billions from international banks. Smart move, right? Except, here's the catch. That debt isn't in your own currency. It's in US dollars. Why does that matter? Because you can't print US dollars. You can only earn them or borrow more. This happened in the 1980s. Countries borrowed massive amounts in dollars. Then US interest rates skyrocketed. Suddenly, these countries owed payments they couldn't afford. The dollar got stronger, their currencies got weaker, and they were trapped. What happened next? International organizations stepped in with rescue packages, but these came with brutal conditions. Sell state-owned companies, cut spending, open markets to foreign investors. Essentially, sell pieces of your country to pay the debt. This wasn't a conspiracy, this was just how the system worked. Borrow in a currency you don't control, and you're vulnerable to pressure you can't escape. Now, what does this have to do with Bitcoin? Everything. Because this same mechanism doesn't just apply to countries, it applies to companies. And right now, there's a company holding over 500,000 Bitcoin, roughly $45 billion worth, and they're structured in a way that makes them vulnerable to the exact same trap. Let me make this even simpler. You own a house worth $500,000. You take out a loan against it for $100,000 at a low rate. Life is good. You're paying maybe $400 a month. Then interest rates go up. Suddenly, you're paying $900, then $1,200 a month. Your income hasn't changed, but your payments doubled. Now you're stuck with three terrible options: sell the house at a loss, take on more debt at worse terms, or default and lose everything. The bank didn't do anything illegal. They just created a structure where when the environment changes, you lose. Now scale that up. Instead of a house, imagine $45 billion in Bitcoin. Instead of a small loan, imagine $16 billion in debt instruments. Instead of you, imagine a publicly traded company whose stock price determines survival. That's not hypothetical. That company exists. There's a company that's transformed itself into a leveraged Bitcoin fund. Here's their model. They raise money three ways: selling stock, issuing convertible bonds, and issuing preferred shares. Then they buy Bitcoin. Lots of it. On paper, this is brilliant. As long as Bitcoin goes up and their stock stays high, they keep raising money to buy Bitcoin. It's a flywheel. Bitcoin up, stock up, raise money, buy Bitcoin, repeat. But here's the buried problem. Those debt instruments come with mandatory payments, about $700 million a year. Nearly $2 million every single day. Their actual business? It generates maybe $100 million in cash flow, not nearly enough. So they've built up a cash reserve, about 20 months worth, less than 2 years. And this is where it gets dangerous. As long as their stock trades at a premium, they can keep selling shares to raise money. The machine runs. But what happens if the stock drops below a certain threshold? Suddenly, selling stock would mean selling Bitcoin at a loss, so they stop raising money. Now that 20-month cushion is all they have. And when institutions know you're on a countdown clock, the pressure begins. Think about the psychology. If you're running this company and your stock gets hammered, what are your options? Keep buying Bitcoin and hope it recovers? You're running out of cash. Sell more stock? That dilutes shareholders and might not even work. Sell Bitcoin? That confirms everyone's fears and sends everything lower. You're trapped, and the people betting against you know you're trapped. But this sounds like conspiracy theory stuff, except it's not. This exact playbook has been used before. In the early 2000s, there was a structure called floorless convertibles. A struggling company would go to a lender and say, "We need cash." The lender would say, "Sure, but you pay us in stock, and the lower your stock price goes, the more shares we get." Read that again. The lower the price, the more shares they get. What's the incentive? Push the price down. Regulatory investigations found that companies entering these deals saw stock prices fall 34% on average within a year. About half were completely wiped out. Real companies, real shareholders who lost everything. Perfectly legal. The Bitcoin company we're discussing doesn't have floorless convertibles, but the dynamic is similar. Create pressure, wait for cracks, profit when distress forces sales. Here's where it gets interesting. Imagine you're a major bank. Your clients want Bitcoin exposure, pension funds, endowments, sovereign wealth funds, but these institutions can't just buy Bitcoin directly. Too volatile, custody concerns, regulatory issues. But what if there was a way to buy billions of dollars of Bitcoin at a 15 to 20% discount? If a major holder gets pressured into selling, they won't dump it on the open market. They'll call a few big banks and say, "We need to move $5 billion in Bitcoin. Who wants it?" Those banks say, "We'll take it," at a discount. Suddenly, institutions acquire massive Bitcoin positions below market price. Then they sell to clients at a markup or hold it themselves. But for this to work, they need real distress. They need that cash reserve running low. They need the stock falling. And how do you create distress? You short the stock. You publish negative research. You create fear. Is that manipulation legally? No. Publishing research is protected. Shorting is normal. But the net effect is the same. In early 2025, this company's stock fell so low, the entire company was valued at $10 billion less than the Bitcoin they owned. Think about that. You could buy their shares and get Bitcoin at an 18% discount. Why would the market do that? Because it was pricing in the death spiral risk. During this same period, short interest exploded. Billions in bets against the company. Major funds publicly announced positions. Banks published research calling it overvalued. Coordinated? We don't know, but the incentives align perfectly. If you own Bitcoin, should you panic? No. Here's why. First, this company is not Bitcoin. Bitcoin is decentralized. This is a company with complex debt. If they struggle, that doesn't mean Bitcoin is flawed. Second, and this is crucial, this pressure reveals institutions want Bitcoin. They believe in long-term value. They just want it cheap. If you panic sell during manufactured pressure, you're doing exactly what they want. You sell at $85,000 so they can hold it and sell to clients at $150,000 later. Third, pay attention to time frames. Even worst case, there's a countdown. If price recovers, if debt gets refinanced, the whole thesis collapses. Here's the difference. When Bitcoin drops 20%, retail thinks, "I'm losing money, sell." Professionals ask, "Why is this happening? Are fundamentals still valid?" If they determine it's financial engineering, not fundamental problems, they do the opposite. They buy more. This is how wealth transfers happen, through psychological pressure at scale. I'm not promising Bitcoin hits $500,000. I'm showing you how institutions apply pressure through legal means. Because investing isn't about being right. It's about understanding risk, managing emotions, and having patience while everyone else panics. Here's what I know. If institutions are engineering complex structures around Bitcoin, they believe in its value. You don't build elaborate strategies around worthless assets. You engineer attacks against assets you want to own but don't want to pay full price for. So, ask yourself, do you believe in the thesis? Do you believe a scarce, decentralized asset has value when governments print trillions? If yes, then short-term pressure is opportunity, not danger. If no, you probably shouldn't own Bitcoin anyway. The best defense against financial engineering? Education. Know what you own, know why, know when someone's playing games. Thanks for watching. If this helped you understand what's really happening, hit that like button and subscribe. See you in the next one.